Welcome to my channel, where we simplify complex tax topics for you. Today, we're diving into a topic that many individuals find a bit complex, but it's crucial for anyone looking to make informed financial decisions: capital gains. Whether you're an investor or just someone curious about how taxes work, the video is for you. Now let's jump into it. This is JW. I'm a CPA working as a financial and tax consultant. I'm also an adjunct accounting professor. I love teaching and sharing what I know. That is why I created this video for you to help you gain some basic understanding of taxes. Well, first things first, what exactly are capital assets? IRS tells us almost everything you own and use for personal or investment purposes are capital assets. For example, home, household furnishing, stocks, or bonds as investment. In the world of taxes, capital gain is the profit you make from selling an investment or an asset. Capital gain is the difference between selling prices and an adjusted basis. We'll talk about an adjusted basis concept later in another video. Let's take a look at an example. You bought a house to live. The purchase price is $200,000. You lived there for 10 years and sold for $300,000. The capital gain in this case is $300,000 minus $200,000, so $100,000 is a capital gain. But the capital gain can be excluded because you owned the house and lived there for 10 years. What about losses? One thing to remember is that losses from the sale of personal use property, such as your home or your car, are not tax deductible. There are two main types of capital gains, short-term and long-term. Short-term capital gain occur when you sell assets that you've held for 1 year or less, while long-term capital gain come from selling assets held for more than 1 year. Why does this matter? Well, the tax rates on these gains can be very different. Now let's talk about tax rates. There are 3 different tax rates that can be applied to net capital gain: 0%, 15%, and 25%. Net capital gain, another new terminology. What is net capital gain? It is the difference between net long-term capital gain and net short-term capital loss. 2 more formulas. We do not like it, right? You don't have to like it. Gone. It's getting too much, I know. You don't have to remember everything here. All you remember is tax rate on most net capital gain is less than 15%. Let's take a look at this table. Your filing status and taxable income range decides the capital gain tax rate. If you're filing as a single with taxable income lower than $459,000, 15% tax rates applies to you. If you file as married filing jointly with a taxable income lower than $517,000, 15% tax rates apply to you. Well, it's not all bad news when it comes to capital gain taxes. There are exemptions and deductions that can help reduce your tax liability. For example, if you sell your primary residence and meet certain criteria, you might be eligible for a home sale exclusion. In addition, losses from investment can offset your gains, reducing your overall tax burden. For example, if you have a net capital loss, you can deduct up to $3,000 losses to lower your income. Before we wrap up, let's discuss some tax planning opportunities. Timing and the market condition. Timing can be crucial when it comes to capital gains. Be mindful of holding periods and the market conditions. Strategic timing can mean the difference between a higher and a lower tax bill. Charity donations. Turn your generosity into a tax-efficient strategy. Consider donating appreciated security to a charity. Retirement withdrawal. For those planning for retirement, optimizing your withdrawal strategy is crucial. By carefully managing which accounts you draw from first, such as taxable, tax-deferred, or tax-free accounts, you can minimize your overall tax burden in retirement. Estate planning. Think long-term with estate planning. The step up in basis at death can be a powerful tool for passing on wealth to heirs. It adjusts the value of inherited assets to their current market value, potentially reducing or eliminating capital gain taxes for beneficiaries. Well, there you have it, basic guide to understanding capital gains in individual tax. To recap, capital gain tax rate range from 0%, 15%, 20%. Most taxpayers are at 15% tax rate. Short-term versus long-term capital gains, depending on the holding time. Capital loss from the sale of personal use items are not tax deductible. Always look for tax planning opportunity to max your tax benefits. As always, I suggest you to keep accurate records and consult tax professionals. Remember, the more informed you are, the better you can navigate the tax landscape and make sound financial decisions. That wraps up our basic discussion on capital gain and losses. If you found this video helpful, don't forget to hit the like button, subscribe for more tax insights, and share your thoughts in the comments below. Until next time, take care and enjoy learning.